Hello everyone, and welcome to the new chapter regarding receivables and sales. After we have completed this series of lectures, some of the items that you will become familiar with include recognizing accounts receivable, calculating net revenues using discounts, returns, and allowances, recording an allowance for future uncollectible accounts, using the aging method to estimate future uncollectible accounts, applying the procedure to write off accounts receivable as uncollectible, and then comparing the allowance method and direct write-off method when accounting for uncollectible accounts, accounting for notes receivable and interest revenue, calculating key ratios investors use, and then estimating uncollectible accounts by using the percentage of credit sales method. Lots to cover in these next series of lectures here. Companies sometimes provide goods or services to customers not for cash, but on account. Accounts receivable represents the amount of cash owed to a company by its customers from the sale of products or services, what we call on account. To understand accounts receivable, we need to start with credit sales from which accounts receivable originate. So in a credit sale, products and services are transferred to a customer today while bearing the risk of collecting payment from that customer in the future. Credit sales transactions are also known as sales on account or services on account. Credit sales are common for many business transactions. Often buyers find it more convenient to make multiple purchases using credit and then making a single payment to the seller at the end of the month. In other situations, buyers may not have sufficient cash available at the time of the purchase, or the transaction amount exceeds typical credit card limits. The benefit of extending credit is that the seller makes it more convenient for the buyer to purchase goods and services. Credit sales should benefit the seller by increasing profitability for the company. But the downside of extending credit is the delay in collecting cash from customers, and then where some customers may not end up paying at all. So even though the seller does not receive cash at the time of the credit sale, the firm records revenue immediately once goods or services are provided to the customer and future collection of the customer is probable. Along with the recognized revenue at the time of sale, the seller also obtains a legal right to receive cash from the buyer. The legal right to receive cash is valuable and represents an asset of the company. Remember, this asset's referred to as accounts receivable. Sometimes we call them trades receivable. And the firm records it at the time as a credit sale. In here, Lynx Dental records this entry at the time of the whitening. Notice that instead of debiting cash as in a cash sale, Lynx Dental debits another asset. Whoops. Lynx is going to debit another asset called accounts receivable. So as you see, it's a credit sale. Sales revenue is credited, but instead of cash, we are debiting the accounts receivable. Let's look at a problem here. On May 7th, Juanita Construction provides services on account to Michael Wolf for $4,000. Michael pays for those services on May 13th. So we are going to record the service on account on May 7th, and then we'll also record when the collection was made. So as you see on May 7th is when we show the asset, accounts receivable, being debited for $4,000 and a credit to service revenue where we provided services on account. And then on May 13th, when the cash was received by Juanita Construction, cash was debited and the accounts receivable was credited. On May 7th, we show we have a right to receive money. On May 13th, when we received that money, we then reduced that accounts receivable since the money was paid. Companies record an asset called accounts receivable and revenue when they sell products and services to their customers on account, expecting payment in the future. Non-trade receivables are receivables that originate from sources other than customers. They could be tax refund claims, interest receivable, and loans by the company to other entities, including stockholders and employees. Notes receivable are receivables that are accompanied by a formal credit arrangement made with written debt instruments or notes. So let's go to a question here. Which of the following are sometimes called trade receivables? Are they accounts receivable, interest receivable, notes receivable, or tax refund claims? Hope you got that. Accounts receivable. They're sometimes synonymously called trade receivables. Non-trade receivables include tax refund claims, interest receivable, and loans by the company to other entities. Next, we're going to talk about calculating net revenues using discounts, returns, and allowances. So, trade discounts represent a reduction in the listed price of a product or a service. Companies typically use trade discounts to provide incentives to larger customers or certain consumer groups to purchase from the company. Trade discounts also can be a way to change prices without publishing a new price list or to disguise real prices from competitors. When recording a transaction, companies don't recognize trade discounts directly. Instead, they recognize trade discounts indirectly by recording the sale at a discounted price. So Lynx Dental typically charges $500 for teeth whitening. Assume that in order to entice more customers, Dr. Link offers a 20% discount on teeth whitening. Patient DK takes advantage of the special discount and has her teeth whitened for only $400. Notice that Lynx Dental records the trade discount indirectly by recognizing revenue equal to the discounted price, which is $500 less the trade discount of $100, which is the 500 times 20%. In some cases, customers may not be satisfied with a product or service purchased. If a customer returns a product, we call that a sales return. After a sales return, we reduce the customer's account balance if the sale was on account, or we issue a cash refund if the sale was for cash. In other cases, the consumer or the customer does not return the product or service, but the seller reduces the customer's balance owed to provide at least a partial adjustment of the amount the customer owes. This adjustment is called a sales allowance. So let's explore how a sales allowance works. Suppose on March 5th, after she gets her teeth whitened, but before she pays, Dee notices that another local dentist is offering the same procedure for $350, which is $50 less than Link's discounted price of $400. Dee brings this to Dr. Link's attention, and because his policy is to match any competitor's pricing, he offers to reduce Dee's balance by $50. This transaction reduces accounts receivable because now Dee only owes $350 and reduces Dr. Link's revenue. The decrease in revenue is recorded to the sales allowance account. This account is reported as a contra revenue account, which means it's reported with total revenues in the income statement, but with a negative balance. The negative balance represents revenues that were originally recorded but now have been reversed because of a sales allowance being offered to a customer. Sales returns are also reported as contra revenue transactions that reduce total revenues. The decrease in the amount owed by the customer is recorded as a credit to the accounts receivable account. Accounts receivable are an asset of the company. Assets, we know, have normal debit balances. Therefore, to show the amount owed by the customer has been reduced by $50 for sales allowance, we reduce the accounts receivable balance with a credit. Now, it's important to note here, we use these contra accounts so we can see how many people have taken advantage of sales returns and/or sales allowances. A common mistake is sometimes people can misclassify contra revenue accounts, the sales return and sales allowances, as though they're an expense. Like expenses, contra revenues have normal debit balances and reduce the amount of net income. But contra revenues represent reductions of revenues, whereas expenses represent the separate cost of generating revenues. Now, sales discounts represent a reduction in the amount to be paid by a credit customer if payment is made within a specified period of time. It's a discount intended to provide an incentive for quick payment. Discount terms such as 210 net 30 are a shorthand way to communicate the amount of the discount and the time period within which it is available. The term 210, pronounced number 2 and number 10, for example, indicates the customer will receive a 2% discount if the amount owed is paid within 10 days. The term net 30 just means that the customer does not take the discount. Full payment, net of any returns or allowances, is due within 30 days. Link's Dental wants Dee to pay quickly on her teeth whitening bill and offers her a term of 210 net 30. This means that if Dee pays within 10 days, then the amount due, $350 after the $100 trade discount and the $50 sales allowance, will be reduced by 2%, or $7. And we calculate that by the $350 times 2%. Notice that Link receives only $343 cash, the $350 amount owed less the 2% sales discount. Similar to sales returns and allowances, we record sales discounts in a contra revenue account. Again, we want to record it in a contra revenue account so we are aware of how many people do take those discounts. It's easier to see the relationship between service revenue and the related contra accounts by looking at a partial income statement. Link provides a service with a normal price of $500. However, after the trade discount of $100, the sales allowance of $50, and the sales discount of $7, Link's income statement reports net service revenue of $343. In this example, there are no sales returns. Any sales returns would also be subtracted to compute net revenues. Like Link's dental credits accounts receivable for $350, even though it receives only $343 cash. The reason is that the $350 balance in accounts receivable is paid in full by the combination of the $343 cash payment and the $700 sales discount. D owes $0 after paying the $343. The balance of accounts receivable is now 0. Let's look at another multiple choice for you. The effect of a sales allowance will result in which of the following? An increase to net income, a decrease to net income, an increase to accounts receivable, an increase to sales revenue. So a sales allowance is going to provide us with a decrease to net income. The effect of a sales allowance is to decrease net income. A sales allowance decreases sales revenue in the income statement. A sales allowance also decreases assets by decreasing the balance of accounts receivable. Here's another one for you. Which of the following computations would be used to compute net revenue? Total revenue plus accounts receivable minus sales discounts minus sales allowances. B, net revenue plus sales allowances minus sales discounts. Or C, total revenue minus sales discounts minus sales allowances. Or D, net income minus the change in accounts receivable. Think through this and what account is in the income statement versus what account would be in the balance sheet. Remember, accounts receivable is an asset, so that would be in the balance sheet. Income statement accounts include the revenue accounts minus any discount and allowances. Those are contra accounts. The revenue recognition standard requires a company to report revenues equal to the amount of cash the company expects to be entitled to receive. Sometimes an additional adjusting entry is needed at the end of the year to estimate any additional discounts, returns, and allowances that will occur in the following year as a result of sales transactions in the current year. This income statement shows the effect of the actual transactions plus the estimated adjustments made for general health. These adjustments are covered in more detail as you get into more advanced accounting courses. As shown on this slide, the amounts reported for contra revenues in General Health's 2018 income statement include actual discounts, returns, and allowances during 2018, plus estimates of discounts, returns, and allowances expected to occur in 2019 that relate to sales transactions in 2018. Let's look at another exercise. On April 25th, Foreman Electric installs wiring in a new home for $3,500 on account. However, on April 27th, Foreman's electrical work does not pass inspection, and Foreman grants the customer an allowance of $600 because of the problem. The customer makes full payment of the balance owed, excluding the allowance, on April 30th. So what we're going to do is record the credit sale, then on April 27th record the sales allowance, and then on April 30th record the cash collection. And then once that is all done, we will calculate the net sales associated with these various transactions. So the first is to record the credit sale. The credit sale would be an accounts receivable on April 25th of $3,500, showing service revenue of $3,500, with our memo being provided services on account. When the allowance was granted on April 27th, we would debit sales allowances for $600 and credit accounts receivable. Remember here, we're not going to debit service revenue. We will debit a sales allowance so we have more information to be able to see what type of allowances have been granted based on our sales. But we do reduce the accounts receivable accordingly. So now the customer only owes $2,900. On April 30th, when the cash came in, we debit cash as an increase to an asset, and we credit the accounts receivable for the full amount of $2,900. Remember, it started with $3,500, then they received an allowance of $600, so the accounts receivable had a debit balance of $2,900. So they paid in full. The last requirement wants us to calculate net sales. Well, the service revenue less the sales allowance gives net sales of $2,900. Let's talk about valuing accounts receivable. So the right to receive cash from a customer is a valuable resource of a company. That's why accounts receivable is an asset reported in the company's balance sheet. If the company expects to receive the cash within a year, it classifies the receivable as a current asset. Otherwise, if it anticipates to receive the monies within over a year's time, it then becomes a long-term asset. To be useful to decision makers, accounts receivable should be reported at the amount of cash the firm expects to collect. That amount is known as a net realizable value. So we're going to talk about recording an allowance for future uncollectible accounts to help us record that net realizable value. Just so you notice, we recognize accounts receivable as assets in the balance sheet, and we report them at their net realizable value, which means the amount of cash we expect to collect. Now, unfortunately, we know based on history that we're not going to be collecting every bit of accounts receivable we show on the books. Therefore, we need to make some adjustments to take into account those people that will not be paying their balance in full. We account for uncollectible accounts using what is called the allowance method. This method involves allowing for the possibility that some accounts will be uncollectible at some point in the future. Using the allowance method, we account for events such as customers' bad debts that have not yet occurred but that are likely to occur. Under the allowance method, companies are required to estimate future uncollectible accounts and record those estimates in the current year. An account receivable we do not expect to collect has no expected value, so we need to reduce assets or accounts receivable by an estimate of the amount we don't expect to collect. At the same time, failure to collect a customer's cash represents a cost inherent in using credit sales, so we also need to increase expenses, such as a bad debt expense, to reflect the cost of offering credit to customers. The bad debt expense is what will decrease our net income. Under this allowance method, companies are required to estimate future uncollectible accounts and record those estimates in the current year. Remember, it's always important to match our revenues with those expenses incurred in making those revenues. These estimated uncollectible accounts reduce assets and increase our expenses. To use the allowance method, a company first estimates at the end of the current year how much in uncollectible accounts will occur in the following year. Estimating uncollectible accounts based on the percentage of accounts receivable expected not to be collected is known as the percentage of receivables method. This method sometimes is referred to as the balance sheet method because we base the estimate of bad debts on a balance sheet amount called accounts receivable. In the appendix of this chapter, we'll look at another method, the percentage of credit sales method, also called the income statement method. In practice, companies are required to follow the percentage of receivables method, so that's really going to be what we focus on in this chapter. In 2018, its first year of operations, Kimsey bills customers $50 million for emergency care services provided. At the end of the year, $20 million remains due from customers. Those receivables are assets of the company. But how much of the $20 million does Kimsey expect not to collect in the following year? The receivables not expected to be collected should not be counted as assets. So by using the percentage of receivables method, the credit manager at Kimsey estimates that approximately 30% of the accounts receivable are not going to be collected. Using the 30% estimate, Kimsey expects that $6 million of its accounts receivable, or 30% of $20 million, likely will never get collected. It makes a year-end adjustment to allow for these future collectible accounts. First, bad debt expense represents the cost of the estimated future bad debt. We include this expense in the income statement of the same period with which these bad debts are associated. By doing so, we properly match expenses or bad debts with the revenues or credit sales they help to generate. Second, we adjust for future bad debts by making an allowance for uncollectible accounts. The contra asset account allowance for uncollectible accounts represents the amount of accounts receivable we don't expect to collect. Earlier in this chapter, we talked about contra revenue accounts like sales discounts, returns, and allowances. Remember that these accounts provide a way to reduce revenue indirectly. So in the same way, the allowance account provides a way to reduce accounts receivable indirectly rather than decreasing the accounts receivable balance itself. We report the allowance for uncollectible accounts in the asset section of the balance sheet, but it represents a reduction in the balance of accounts receivable. The difference between total accounts receivable and the allowance for uncollectible accounts is referred to as net accounts receivable, which is also called net realizable value. In the 2018 income statement, we reduced the $50 million of revenues from credit sales by $6 million in bad debt expense. Even though the company reports credit sales of $50 million, the expected profit on these sales after considering the cost of future bad debts is only going to be $44 million. After we estimate uncollectible accounts to be $6 million, we reduce the $20 million balance of accounts receivable and report them at their net realizable value or estimated collectible amount of $14 million. But is this estimate correct? Time is the only true teller of this. Kimsey's prediction of $6 million for uncollectible accounts could be too high, it could be too low. But in either case, it's generally going to be more informative than making no estimate at all. Another key to remember is that adjusting for estimates of future uncollectible accounts matches expenses, those bad debts, in the same period as the revenues, those credit sales they help to generate. Recording an allowance for uncollectible accounts correctly reports accounts receivable at their net realizable value. A common mistake, because allowance for uncollectible accounts has a normal credit balance, many people sometimes misclassify this as a liability, and they also have normal credit balances. Instead, remember this contra asset represents a reduction in a related asset account. If you think about the asset for equipment and then the contra account accumulated depreciation. Accumulated depreciation has a credit account, but that doesn't mean it's a liability. It's an offset to a normal debit balance. Let's look at a problem here that we'll go through. During 2018, its first year of operations, Pave Construction provides services on account of $160,000. By the end of 2018, cash collections on these accounts totaled $110,000. Pave estimates that 25% of the uncollected accounts are going to be bad debts. So our job here is to record the adjustment for uncollectible accounts on December 31st, and then calculate the net realizable value of accounts receivable. So the first thing we're going to do is estimate the allowance for uncollectibles. We will do a debit to bad debt expense, so we match our expenses with our revenues in the same period. And we'll take the $50,000 times the 25%, or $12,500, will be our debit to bad debt expense, and our credit to the allowance for uncollectible accounts. Again, remember, this allowance is a contra account of our accounts receivable. Next, to create the net realizable value, we would show our full accounts receivable of $50,000, subtract from it our allowance for uncollectible accounts of $12,500 to give us our net realizable value of $37,500. Here's a question for you. Which of the following is true regarding allowance for uncollectible accounts? It is a liability account. It is added to the total of sales discounts, sales returns, and sales allowances. It is subtracted from the balance of accounts receivable in the balance sheet. Or D, it appears in the income statement as an expense. What do you think? It is subtracted from the balance of accounts receivable in the balance sheet. The allowance account is a contra asset and is used to record estimated future uncollectible accounts. The balance is subtracted from accounts receivable in the balance sheet to arrive at accounts receivable net realizable value.